All right. Good morning, everybody. Japan down again 2%. It seems to tie in with selling bonds, buying gold. Hong Kong is basically flat, although there are more and more articles pointing out that this could be the start of a whole new regime for Hong Kong looking out over the next half century. That's too far down the road for this. Small caps up almost a 0.5%. The Dow is at half, same with S&P, NASDAQ beyond that, really pushing for 0.75%. And Europe is up, but we should get news out of Europe. So, or at least we're going to get some Fed speak out of Europe that might shake things up a little bit. We've got U.S. market, U.S. Fed speakers. I didn't see much out of Logan in Tokyo, but today we have retail sales and business inventories. And then later on tonight, Daly speaks daily. It's OPEX this Friday. Third Friday of the month is always OPEX. We're going to get auctions on the front end today. So 3-month, 6-month. Usually when you see auctions at 11:30, even if you don't see any for 11 and 1 o'clock, just go ahead and anticipate that there's going to be auctions at 11 and 1. Remember, they don't always list every single economic event. It's why we go to different places. But even with going to these different places, we're only seeing maybe a third, maybe a little more than that. But at most, we're seeing half of what comes out on a day-to-day basis. There are places where you can dig down deeper and really get into the weeds on more economic events. It's the same one that Thinkorswim uses. Econo Day. So all of these on Thinkorswim are really just imported in. Thinkorswim is attached to a company called Econo Day, and on that website they have these, and then they also have so many others: grain, agriculture, metals, shipping. There's just so many events. And then we're going to get data out of China tonight. So you can see Bank of England and European Central Bank speakers. That's the discussion or the idea that we could see a change out of European markets this morning. Remember, Europe doesn't close till 11:30, so whatever's happening over there can absolutely affect our market through the morning. But if we get news out of Europe that pushes us down and then they close at 11:30, we can pop right back up. And if we get news this morning out of Europe that pops us up, they close at 11:30, we could fall back down again. So you kind of want to take a look at what the market has been doing through the morning and reflect on the idea, did we get here because of Europe? Up or down? Because if we got here because of Europe and then Europe closes, it's very likely whatever direction we were going, we're going to stall out and go the other direction. Now, that's not always true. Just like how we can have a good day, that bleeds over into the U.S. markets, and then all around the world, everybody has a good day, so that when we come back in the morning, the market just continued to do in the overnight hours what we had done the day before. Europe can kick off something good or bad. And after they close, we can continue that move, good or bad. So it doesn't have to be a flip or a reversal. Eight 30, 10, 11, 11:30, 1 after 1 o'clock should be good to go for any of your afternoon 0-day plays. We're looking at a weekly chart here on the right side. We've come down into the 10-period moving average, and we haven't done that. We had QRA back in November, FOMC, QRA, and then this fantastic move. We haven't been down to this 10 since then. Now, a 10-week is close to a 50-day. They're not perfectly lined up, but whenever you're on one chart versus the other, you just look at whatever moving average you have. Now, this is just a good reset, all things considered. We needed this kind of pullback. And there's a lot of talk going on about how this is indicative of some bigger shift, that earnings better come in the sweet spot, that it can't be too negative, that the economy is too hot for the Fed. They're not willing to cut. Inflation's starting to rise. Energy costs are going up, exacerbated by war. All these bricks in the wall of worry that says we're going to break structure and head down, 49, 48, maybe even 47. There's always that threat. There's always something in the wall of worry. It's a wall, not a gate. So when you consider that wall of worry and the things that could go wrong, just remember how many times there's some form of intervention that, whether it's Japan or Europe or the US, that somehow they manage to pull everything together, and we yet again avert some crisis, and we avert some bear market shift, and we just leg up into a whole new zone. Not to say that you shouldn't have some caution, or that there aren't any threats, because there are, and there are serious threats that could send us down into those 4,000 area. So we're at the 50 day or the 10-week. If we do break this structure, then we're going to the 20. That's just the way it is. It's not a discussion of if. It maybe. If we break structure, we're going to 5,000. If you read the founder's note, they talked about on the SPX that there really isn't much structure underneath there. Now, we don't have the AM spot gamma notes yet, but we know what they were talking about on Friday, that 5150 needed to hold, and that there really isn't much until 5,000 otherwise. But won't. There's the 50-day. So we needed a good pullback back in the day, back before COVID. When we were in a good bullish market, we were all waiting for these 5% pullbacks and 7% pullbacks for a nice way to kind of reset everything for the next leg. And I don't think we're even at 5% yet. Try to find a higher point to pick off of here. 3.44. Not even at 5%. If we do make it down to that 20, that would be almost 6.5. a good 7% reset can offer us another 14% to the upside. Sounds fantastical, doesn't it? We don't really need to focus that far into the future. We have last week's range built within last week's candle. 52.17 is the halfback that we need to could be concerned with. We've got to get through that level to do anything else. And if we tighten everything up and just look at Friday, 5,200 is the halfback, which is what we're struggling with this morning. We're right underneath that halfback level. Remember, liquidity resides on the other side of the pivot. Well, there's the pivot, and we're not going to the other side. Liquidity is actually in front of us. It's in front of the pivot. So let's get through 5,200. See if we can get on the top side of that weekly pivot point. That would put us in a more bullish neutral posture. Just being above it would be bullish, but not yet more than bullish neutral, because we still have all these other pivot points to get through. We would still be underneath the volatility trigger, the 0 gamma, the 10-day moving average, 20-day moving average. There's a lot of resistance overhead. There's a lot of reasons to believe that we're not going to rally out of this easily. I get that. There's so many things that could trigger this move back up to just shake off those bricks from the wall of worry. From, intervention in Japan to an end of the war, say in Ukraine. There's just so many things that can be brought out to trigger the animal spirits and rip to the upside. Even something like Nvidia coming out with a whole different earnings, right? A whole different product line, and who knows? There's always some thing that they point to and say, oh, it was this news, this brought us out. Well, we'll see. Until then, looking at a daily, you can see we continue, even just using OCR style analysis, lower highs, lower lows. We're at the 50. It's kind of a pivotal moment. We don't really want to break structure underneath that 50 because the 200 is a long ways off. When we think about what's on deck, May 1st, QRA and FOMC. So seeing this market chop about for two more weeks, little sideways shenanigans, just holding the line, maybe dipping down a little bit lower, but really not giving up these lows, and also maybe not even climbing back out yet, right? The market's going to get into a holding pattern. It's going to wait for that data when we get a little closer to FOMC. Cumulative volume, market breadth in the NASDAQ is pretty negative. That's net selling across the board since the start of May, the start of April. That's what they say. I don't think that necessarily applies to futures. And if I remember right, there was a pretty good article that they had come out with on Bloomberg a few years ago. You'd probably be able to find it pretty easy on a Google search about the statistics on that comment. The comment is sell in May and go away. Um, seasonality is seasonality is a really interesting thing. When I first heard about it, I dismissed it, just off the cuff, dismissed it. And yet, years later, I've got a lot more respect for it than I used to have. I don't trade because of it, but I certainly keep my eye on seasonal issues because I don't know, because governments are lazy and corporations just do the same things over and over. Seasonality is a real deal. So it's certainly worth checking into. Right, like astrology. Um, yeah. Even Thinkorswim has astrology on its home screen. So who am I? Right? Who am I to say one way or the other? But I would say hit Google. I'm pretty sure it was a Bloomberg article that did a deep dive on that sell in May, go away phrase. And then, just remember it's an election cycle. So make sure any research that looks at a sell in May scenario is also recognizing, that it's an election cycle. Yep. They usually break it down that way. So it shouldn't be too hard to find. 10-day, 30-minute volume profile. Even if we were to use the most generic way of drawing a reg line, so I had someone mention the other day that they don't have a linear regression line on their platform. This is an old school trick. It's not as good as using a lin reg line, but just click either the highest point or the lowest point if your chart is moving to the upside. We're moving to the downside. So we're going to start at the highest and move to the lowest and just snap your line there. Another way that you can do it is start at the very first candle you see at the open of the very first candle and go to the close of the very last candle. Now, those two lines seem radically different, but really they're not that bad when it comes to linear regression lines. So that's just a regular line that I drew using the open of the very first candle and the close of the last candle. If I use an actual regression line, just start at the first candle, drag it across. Not that much difference there, right? So if you're on a platform that doesn't have linear regression lines, you could try that old school tactic of just starting with the first candle at its open and the last candle at its close. It's going to give you a general consensus of the mean. It's not as good as doing the math, right? But kind of give you an idea. Also, the trend is pretty dominant. When you snap that line, you got a clear picture of where the market is going to the downside. Obviously, we haven't built a base. We haven't stopped falling. We've got nothing for any sort of a turnaround. We also don't have a classic shape unless we were to say that this is a classic D, which all things considered, I find it hard to say that just because of the extra volume structure here. But if we were to call it anything, that's what I would say. It'd be a classic D. Not yet a B. We would want the volume profile to be in the upper part if this was going to be a classic B shape. We wouldn't want the profile right in the middle, right? The point of control. And that's where it is. So it's not a B. We do have this shallow area and a large volume shelf around this 5,200, which we're underneath. There's a lot of ways to think about this volume shelf here. You can call it resistance, or if we were above it, you could call it support, but just think about what it represents. A lot of traders there's no arguing with that statement. If I call it support, somebody could argue, call it resistance. Somebody's got an opinion. There's no real opinion to the fact. The fact is that's just where a lot of volume happened, right around that 5,200 area. And rather than just a single line in the sand, it's actually a zone. We've got to get through all of that liquidity. Now, we don't know if old volume is going to represent new transactions or new trades at that spot. Maybe the people that traded there are happy with their trade and they're not going to readjust or add or reposition or do anything else, just going to let it ride. I would ask you to think about yourself. If you got in at that spot, higher or lower, right? Long or short, you got in there. And here we are 2 days later and we're back there again. What are you going to do with your trade? Would you just let it ride? Or would you adjust it in some way? Because those adjustments are going to be transactions. They're going to be trades, whether that will be resistance or selling or buying. So when you have this zone here, just anticipate that there's liquidity there. You should see it on the dome. You should see pulling and stacking, right? You should see that activity within the structure of price. So that if we come into that zone and try to get through it, see an elevated tape speed, see them refilling or stacking on the dome, blocks and sweeps start coming in. And we'll see sellers defend this level and price goes back down, or we'll see those orders get shifted out of the way, maybe absorbed. We work through that structure and aim for the next one. We don't have to guess or assume. There's a lot to using a volume profile. One of the things that we always want to focus on is where is the bulk of all of the volume? Think about yesterday in this entire move, all of the volume is in the lower portion. Now, Spot Gamma's done conversations about that when it comes to like options levels and things. But if you go and study volume profiles, where the volume ends up on a move usually has a lot to say about where we're going in the future, right? Or how price is going to respond if we come back down to that level. So we do have a new VPOC. We're going to mark that out in a minute. This is a classic B shape from yesterday. It's a perfect example. And those shapes go directly to the heart of where the greatest amount of volume was located, whether you're doing a volume profile for, you know, an hour, a day, or even candle by candle. All right, I think that got us where we need to be. Nope. Really? It'll do. I think I might be off a tick. 51.69. And a tick. So there's the new VPOC. Should we come down into that zone, we're going to expect some trading at that level. It was where the greatest amount of volume happened on Friday. So it's the same conversation we just had. We don't have to call it support or resistance. We can just focus on it as a level where we would expect to see a lot of trading come in. We would expect a lot of trading activity. at that spot. So last week we measured this range, and it was early because the market hadn't closed yet on Friday, and it doesn't count until the market closes. It just gives us an early idea of what the volatility looks like for the coming week. But now we're in the new week, so we can measure last week and compare it to this week and ask that question: is there more volatility this week pricing into the market than there was last week? And the answer is yes. We can see that in the gap here. If there was less volatility, that green line would be inside the box somewhere. If it was the same amount of volatility as last week, then the box would be the same size as this week. But instead, the green line is sticking out. We can see there's more volatility. That can equate to a lot of different things. On a day-to-day basis, we can expect the S&P to make bigger moves. On a week-to-week basis, or at least just for this week, we could expect to see the market move in a single direction farther. So, if we had gone last week all the way to the top, or like we did all the way to the bottom. So volatility gives us things like expected move. And that's what this is. The expected move for the week is a little bit bigger than the expected move from last week because the volatility is greater. We're still above the 10-week. And we are moving away from it slightly, not by much. And we're still significantly underneath the 10-day. So any rally has to take the 10-day into consideration because it's now over our head. And it's been a long time since we've had the blue line underneath the 0 line. We haven't had that for a while. But you can see periods in history where that blue line was underneath the 0 line. There's one example. Little dips really aren't the issue. It's longer term, right? Staying down there for a while. So we can get close like we did back here. We stayed above for a long period of time, threatening to cut below, but not cutting below. And we had an unprecedented run. It can act as a magnet. That doesn't mean it always is acting as a magnet. Something to consider, right? If you go and read about VWAP when it was first being hyped up, and there's a lot of books on it that talk about how back in the day, brokers would offer that service to big firms and clients. That way they would say, we promise you VWAP price. If you want to collect 10 million shares of Apple, we promise you VWAP price. And 10, 15 years ago, that was a pretty bold statement. Nowadays, well, with technology and everything, it's not so amazing, right? It's not so wow. But back then, that was pretty awesome. So just think about what that would mean if they could offer VWAP prices. That price would be triggered trades and transactions would happen around VWAP if they were selling a big firm out at VWAP prices, or if they were getting a big firm in at VWAP prices. So it can be a magnet. Absolutely. And then it can also be the opposite. On the other side of that, as a perspective of what is VWAP, it's average price. So the analogy on that is driving by the gas station every day and you see $3 a gallon, $3 a gallon, $3 a gallon every day, every day, every day. Suddenly you go by the gas station and it's $1. Even if you don't need gas, you're probably going to consider stopping in and getting gas because, oh my gosh, it's really cheap. Drive by that gas station every day, $3, $3, $3, $3. You drive by and you see $6. Even if you really need gas, you're going to say, screw that gas station. You're going to try to find gas somewhere else because it's just way overbought. Take that back to VWAP. When we have something like the ES stretched that far beyond VWAP and they're still buying it, they're still buying it hand over fist, happy to be buying it. There's only one side to this trading on that run up. There was nobody going the other direction. One time framing, single directional push. Everybody was paying that $6 for gas and loving it. They didn't care. They wanted it. They wanted it so bad they bought it that much more above average price. Yep, yep. If you get more into VWAP, start looking at anchored VWAP. That stuff. For futures, it's not wow. I mean, it's okay, but for equities, it's pretty wow. Yeah, but it seems arbitrary how you can anchor from different places. Highest volume, the start of a new week, the last big gap up on a daily or a weekly, earnings, new contracts for futures, start of the year. There's so many anchor points that you could choose, but anchored VWAP, and Brian Shannon's the guy for that. He's got some really great material out there. He didn't make it. I think he's just the one that really promoted it the most and hit a lot of brokers, asking them to put it on their platforms. We do have China up this morning with the KWeb constituents. So we would expect Baba, Baidu, JD, PDD, Neo, XBev, all those guys to be doing good this morning. Semiconductors are up through SMH. So we would expect that constituent to be doing relatively well. Financials are up. Gold, miners, communications, industrials. It'd be almost easier to ask what's not up. The FANGs are up even. There's two sectors that I really focus on when we're looking at a rally day: the financials and technology. But consumer discretionary fits into that. That's the three, right? The trifecta. And of course, you can broaden it out and say semiconductors and communications. There's always more ways that you can muddy the water, but tech, consumer discretionary, and finance. Now, finance is like the tag along kid. It's not going to be strong enough on its own to really rally the market. But if the market is rallying and we have finance with us, well, at least we know it's not fighting us. So we'll take it, right? We don't want finance to act as a drag chute like those fast cars that pop a parachute out the back. We don't want it holding us back or weighing us down. So the fact that the financials are up bodes well for today to be one of those rally days where we really try to take back some of this 3.5% move off of the highs that we're down. The VIX is down. Nat gas, which who cares? Bitcoin down. That could hit a little bit. Bonds are down, which is weird. And that's it. There's nothing else really down enough to meet our criteria. We have the conditions this morning for a continued rally in the market to, at the very least, get back above Friday's high. Now, I mentioned it at the start, there's a lot of trouble with that. Volatility trigger, zero gamma, both of the ADR levels, the 10-day, the 20-day, even this voodoo line in green, pretty sure that's the forest voodoo line. All of that is in our way for a rally up today. Plus the halfback of last week and the halfback of Friday, really. We still got that one in our way. That's a lot of resistance. It's just a lot of things that we have to work through. And there's still that liquidity gap that needs to be filled. So I'm going to argue that one step at a time, right? That we get through the weekly pivot point. We get through this 3-week moving average. We get through the roundy, 5,200, all of that. And then we can start working on the options levels, volatility trigger, zero gamma. The thing is, we might continue to see the S&P and the NASDAQ kind of chop and just hold these levels without rallying back out. But we might see the rest of these continue that rally, right? So things that are up here. It wouldn't be the first time that we've got equities making moves with the indexes themselves stagnant and sideways. And if it's going to be like that, it'll be some choppy, nasty price for the futures. All right, so we can see BABA's up at that nice gap. It's got a lot of work to do just to get back to or back above the halfback from Friday. Now, there's two ways you can draw Friday. You can draw it from where we closed on Thursday down to Friday's low, or you can just do the RTH. And I just did the RTH. So 72.40 is the halfback we've got to get through. Then we could focus on RTH of yesterday, or at least the Globex pre-market. 73.5. Get above that, 74.75. It's a nice run. I don't think we can get this gap closed unless we get some kind of fire lit underneath this thing, but look at how it closed Friday. Just a big gap down underneath all of the major moving averages, and it closed at the lows. So a really negative event. Now, red to green, if we can pop up in the pre-market, even just half of Friday, let's move this to just Friday's candle as it's shown here. There's our halfback, 72.14. The other way that you can draw it would be using the close up there, right? That's not really going to help us out right now. So get above that 72, focus on 73. This big gap will eventually be something we can focus on to fill, but all of these moving averages are the trouble, which also happens to be Friday's open. So if we can get above 72, we can at least get a trade to 73. I would get most of it off at that point. Baidu, same thing. Triple bottom, lots of trash. Red to green at the moment. A really good red to green would gap completely outside of yesterday's range, closing at the low like this, and then opening the next day, completely outside of the previous days. That's a really good red to green. So far, we're not seeing that kind of a push. PDD, another one, closed at the lows, gapped in the pre-market. All these moving averages overhead. Lots of resistance to get through, even just through yesterday's price or Friday's price. Got to get through the halfback. They all pretty much look the same. When it comes to China, EDU is a name that I continue to focus on. This also was red to green. It's not getting any flows yet this morning. In the after hours Friday, it went even lower, but nothing yet this morning. Still, this has been doing pretty good ever since its recovery from this short report that came out. They had things that needed to be resolved. So we got the China ADRs. We have the FANGs or the MAG 7, gold miners, semiconductors. We're set up pretty good. Just have all that resistance to deal with. Keep your eye on the Fed speak. Watch the clock. I'll see y'all tomorrow.